So shall I start? Am I supposed to start? Hi everybody, it's a pleasure to be here. I am the humble moderator of two stalwarts, Renu and Gopal, who know no introduction, and we have very short slots, so we won't waste time. This is a kind of a nationalistic panel. You've just heard the big boys before us talk about buyouts and control deals, and I think that there is no lack of enthusiasm or energy on the panel with us. But I think the topic which is leveraging our AIFs for M&A and control transactions, is really to bring out how domestic venture capital should be more on the same playing field as the foreign PEs. And so let me start maybe with Gopal to put it in context. So what are the volumes of PE deals? Where would the domestic PE deals fall? And what are the kind of returns that our domestic funds have had compared to growth and early stage funds? So maybe we can start with the landscape and then we can go straight into the pain points.
Thank you, Zia. There's a fantastic panel before us also which had a similar overlapping points. So the audience, I'm sure, is keyed on to this subject. In my mind, out of the reports of E&Y and others which talk about $56 billion or so, which I think is about 7.5 trillion rupees of investments in VCP in India, clearly what you are able to see is that the returns are, of course, like always varied, but the median returns as published by the SEBI driven benchmarking study still points out that for the average Indian investor, between investing in private equity venture capital versus investing in public markets, there is an emotional challenge. And I use the word emotional because they want to invest in private as an asset class. They see the value of long-term compounding, and they see the value of basically this becoming the new age of India. But there is not a great difference, and often the public asset class is higher. So the way I understand it is the single biggest challenge for private equity in India to get better returns is firstly to increase the availability of assets. Where can we invest? Because if you go back to venture and growth, it is quite crowded. And therefore, obviously, the markets are being efficient. And when there's competition, they bring down the rates to the right level. So asset availability is how I would frame the problem for India. If we can get more assets, different kinds of assets by using different strategies like control, like buyout. In India, for example, about 30% last year was actually under the buyout stroke control heading. Out of the 56 billion, it's growing very fast. 38 actually, it's 30% globally. And the only point I want to add is when you look at median returns, because that's typically what the larger institutional CIOs see, the median returns in the control buyout area globally are 3 percentage points higher than the median for venture, private equity and control put together. So the median is the more important number because it means a larger number of people can participate in a better return. And therefore, I think control, M&A, buyout is the way to pave our new paths to finding more and more assets. Remember one thing, Zia, just one number I was just reading before I came here. In a 4-5 trillion economy, the industrial value, the industrial part of the GDP is about 1.25 trillion or so dollars. And therefore, with scale, opportunity comes in many different forms, and surely control, M&A and buyout, I believe is the next way to get those extra 200-300 basis points of return and make sure our institutional CIOs and family office CIOs feel that yes, I need to put it rationally into this asset class, not only emotionally.
That's really true actually. But Renuka, we were discussing earlier, the problem for domestics to get into control and buyout deals is really the leveraging and the funding. And maybe you can explain why, as we were discussing, domestic venture funds are today at a disadvantage because the lack of leverage available. Maybe you can talk to that.
Thank you, Zia. Thank you, IBCA, for having me here, and also the wonderful work you do throughout the year, culminating into this event. Taking forward from what Gopal said, when we talk about having a larger set of opportunities that investors like us can invest, the way people like me, Gopal, see our asset class, we are a solution capital. You can call it VC, PE, buyout, control. You can give any number of words to it. But finally, we are using capital to find solution for a problem. And when it comes to solutioning problems like family has 4 brothers now, only 2 brothers want to continue with the business, 2 others want an exit, or a bunch of friends came together, one person wants to continue and others want to take an exit. There are very many problems. There are listed companies who do not have a viable existence in the listed space and need to get delisted by taking control. Our product, our asset class is absolutely the right solution capital. But because in India we have a set of AIF regulations which are drafted to protect the smallest of the small investor, and we have regulations from Reserve Bank of India which is also trying to look at the larger macroeconomic picture of how much the country is borrowing, in what forms and shape is the money coming in, and are we indebting our economy by allowing private equity guys more freedom. And the fact that the regulators don't talk to each other, and the fact that we take some old archaic rules and try to modify it to take care of the newer requirements of institutionalization of ownership, delisting companies and so on, no matter which road you take, you hit a roadblock, you hit a wall, and you are trying to somehow structure a deal around it, which is all compromised everywhere. And this problem is uniquely faced only by Indian managers like us, who raise money in India and who raise money abroad. So we have an AIF vehicle, we have a GIFT City vehicle. GIFT City vehicle has all the flexibility. AIF vehicle has lot of limitations, and you are tied in the hip because the investors don't want you to have mismatched portfolio between these funds. So you're constantly spending a lot of money and to find suboptimal solutions where ideal solutions can indeed be available and be at a level playing field with our global peers. So the sum and substance of all of this is, as we speak today, about $10 billion of control transactions happen in India. That means $10 billion of change of ownership of Indian companies which are going to benefit from the growth of India. More than 90% of these deals are done by global funds, not because local funds don't have the capability to do it. They just don't have the avenue to do it. Now, there is a smooth transition of Indian ownership happening to foreign shareholders, literally excluding Indian investors from participating in it. Indian banks, Indian insurance companies, Indian pension funds, because of our regulatory restriction. Now, is this being understood by the powers that be? Is this desirable for us as an economy? Is it fair to the savers in India to let go all the Indian opportunity to foreign savers and foreign pensioners? Is a question that we as an industry have been kind of asking all the regulators and asking for solution.
If I can just follow on with that with you, Renu, can you basically tell the audience a couple of further pain points? One is how the bank, if it invests, cannot lend. And the second is the co-investors have to be the same in an AIF, but in a GIFT City model, you can have third parties who can co-invest, which again cuts down the limitation of capital and avenue to access to capital available. Gopal, you want to take that? Whoever.
Yeah. So I mentioned about how we take old laws and try to tweak it for new requirements. So Gopal and I were part of the same committee which was pressing SEBI to give us solutions for co-investments. Co-investment is a very perfectly proven thesis globally. There are many solutions like collective investment vehicles, or you can even come in the main fund in a separate scheme of units. There are extremely practical, simple solutions that are available overseas. Our regulator did not want to change the regulation, instead wanted to use the PMS avenue for allowing co-investment. While this does provide an easy solution, a quick solution to the industry's demand, it comes with a lot of challenges of its own. In PMS, the investor is the ultimate owner. His name has to be in the cap structure, so the issuers have a big problem with it. In dematted shares, you cannot give control to the manager, and therefore who's going to take decisions on those shares remains an unanswered subject, which further bothers the issuers. There have to be so many documentations done between the main fund and the PMS fund on how these investors are going to behave on a going forward journey, and do the manager have full unbridled control on those PMS shares the way they would have if it were another scheme in the same fund or any other structure that are globally viable. So while technically we have a solution, it is such a suboptimal solution that when you go in front of your issuer, he has two solutions. One, a global fund can give you one check and be done. And a domestic fund like mine or Gopal's will go there with a complicated solution that my main fund would do so much. I have 10 co-investors with me. You will sign 10 different documents. You'll have 10 names on your cap structure. And each of us comes with our own structures. One is an LLP, another is an individual, third is an institution. What is the issuer going to prefer? So how do we get the regulations to put Indian managers in level playing field with our global peers has been a matter of great challenge for people like us who want to participate, as Gopal said, in the same set of opportunity, and we have the capability to do it. We can find the money to do it, but we do not have favorable regulations to do it.
Gopal, let's talk a bit about leverage buyouts. And that, as you know, has really not been a common practice in the Indian industry so far because of our regulations. So how do you think RBI can support, and how can they complement SEBI's efforts in supporting M&A, reviewing some of their guidelines, including the recent one on who can invest in AIFs, etc. So how do leverage buyouts come to you as an AIF? What would be your wish list?
So in the interest of time, I just combine that in a couple of points here. I think the main, first is, Renuka has done an excellent job laying out an issue list. I also want to pause and say lots of good things have also happened. And I think IVC has done a terrific job bringing the industry together to both government in Delhi and SEBI. For example, now you have promoter-less IPOs. That's a very, very big thing.
Reverse mergers.
Yeah, we have reverse mergers. We have flipping of companies very, very smoothly. So one single rate of LTCG.
Gopal had made it his singular mandate to equalize tax between listed and unlisted companies.
You might want to mention what has happened.
Yeah, so these are all some good things that have happened. But coming to the point that Zia is correctly raising, what are the solutions going forward? For example, in leverage buyout, RBI has rules for leverage against shares only for listed shares in Group 1 of NSE, and creating an AUM of about 50 to 60,000 crores, which is really, really something the banks will typically say, there are rules for this, you are not mentioned anywhere, and hence, what do I do? Therefore, I want to touch on a larger point the Chief Economic Advisor and FM said in this year's budget, which made, I think, everybody in India so happy. Probably the only thing happier was the tax cut for the middle class. And that was to say that deregulation is a driver of growth. Micro control must be eschewed. I think that was a fabulously powerful statement. So if I was to wrap that cloak around me and pretend to be Superman for a second, what would is that I would want? First is getting moksha, if I had to define it here for us, would be to unify with IFSCA rules. It's a one-line moksha. Everything that we feel as a problem is actually heaven as far as IFSCA is concerned. So what does that mean? It means, one, leverage being available for loan against shares to AIFs so they could invest in companies. It means, two, this will also help, of course, for companies to buy other companies in the control situation. Second would be, from a point of view, we have a real major issue in terms of many of the VC funded companies are being rolled up. And when they are rolled up, it's not a moksha type of merger. It's a part share swap. 30%, let's try with 30%, we'll swap each other's shares and let's try it out. But given the way valuations work, such mergers are not tax neutral as they are in a 100% merger. So is there a way we can actually encourage mergers in the spirit of this team by allowing, let us say, partial share swaps of some significant amount, say 25, more than 25%. That is certainly one thing that comes across. And the third thing we really worry about a lot is this entire co-investment. In our report in which Renuka and I have involved, I think we came up with a simple suggestion. We said if there is a large value accredited investor and QIB fund, LVAIAIF, I know it sounds very long, but if you have a fund where only very large accredited investors, not the ordinary ones, and QIBs alone can participate, that can have the same set of rules as what is there in IFSCA, which means co-investment, which means leverage, which means special purpose vehicles. It could mean redemption in the middle of the fund life because, you know, we heard a friend here talk about unlimited fund life. Now imagine Renuka's next fund is a 30-year life, but for such a life, it must have redemption built into it. Westbridge has a has a nearly $10 billion fund now, which is basically has redemption built into it. So that again helps again with M&A and control buyout. So moksha to me is a merger of these two rules, which should be possible if these investors are willing to say, I am aware of the fact that investor protection for me is not the same as what is offered to everybody else, a point Renuka made in the early part, because that is the first opening clause of SEBI law, which says it's meant for investor protection. So in some soft way, if they say we are large, we are responsible, we have the capability to be managing ourselves, then we can get that one large value accredited investor AIF, which basically allows this to happen. So this is my hope. And if this happens, I think domestic capital will pour in. And as Renuka pointed out, why are we making the life of pensioners in Florida alone better? Because their fund is able to invest in a tollway in Gujarat. No problem. Let them also be better. But let's also make sure that Sabka Saath and Sabka Vikas is also available for all the Aam Aadmis in this country.
So why do you think that institutions like insurance companies, etc., have such a low allocation ascribed for private equity? And even that, I understand, has to be distributed amongst many funds so that the actual dollar amount or the rupee amount that hits our domestic AIFs is very, very low.
I think two things, Zia. One is the thing that you know better than all of us. And in India, the wrongdoer makes the law. Right? Outlaws make laws. And that I think is a sort of mindset that is for all of us. As an Indian, I'm sure I have the same mindset. So rules become very arcane. Say, IRDA has put, I think, a 2 or 3% cap on the total amount of money that a fund can invest, insurance funds can be invested in AIFs. Having said that, I would say the insurance CIOs have been super enlightened in seeing the fact that even if they make 13-14%, which is below the median, they're still doing so much better than 5-6%. And so they are maxing out nowadays. Nowadays, you see more and more insurance companies writing larger and larger checks. So we would need to work on our track record and convince IRDA to uplift that 2 to 3% to maybe 5 or 10%.
But is that something that IVCA should be doing by way of advocacy to the regulator?
I think so. I think that's
So
that and the large value AIFs, and then working with RBI to basically make sure that loan against share rules for unlisted shares are also amplified. These could be 3 areas. The biggest area, if you ask me, as big as all 3 put together, would be getting the 25 to 30 trillion rupees we have in pensions and endowments to start having allocations into private equity, maybe through fund of funds or whatever safe mechanism exists. But that's 30 trillion rupees at a 5% allocation, that's 1.5 trillion, growing at about 15% a year. So I think that is another big one.
What, Renuka, would you like, which is available to AIFs in GIFT City, to be regulated here to give us that freedom to do the same thing? One is, of course, the co-invest, where third parties can come in. What else? And you talked about the pain of relocation also. The relocation of AIFs into GIFT from Mauritius. Maybe you can touch upon that as well.
So one very simple thing we would like is to allow AIFs to borrow. AIFs to borrow. So globally, if you see, most funds leverage until they have to draw down. Absolutely. So that it has many operational advantages besides financial advantage. In India, we are allowed to borrow for 30 days, and that too only for defaulting investors. So that itself puts us at a very, very non-level playing field. So, and funds like us who are joined in the hip with GIFT City, we are not able to get the best of GIFT City because you are caught in the lowest common denominator between SEBI and the GIFT City rule. So our earnest submission to SEBI would be to really look at this financial sponsor product that every bank in the world is desperate to give because it's a risk-free product for them. It's against the drawdown, and it simplifies operations for the manager and also enhances the return and puts them on the level playing field.
I think we were talking about how you have seen the growth of HNIs and family offices coming into your domestic funds. And that has to be a growing trend for both of you, I should think. And therefore, to your point, you should allow Indian shareholders and unit holders and investors to partake as much of the India growth story. Now, where do you see that being curtailed when you have a QIB and you have to have an AIF be an anchor investor? Now you need at least a certain percentage to be institutional investors and not just family offices and HNIs. Do you see that as positive or what? So today if you're a QIB and you have to be accredited QIB, you can no longer just have a bunch of family offices. At least 50% of that have to be sovereign funds or broad-based funds, again foreign global funds. Is that been an issue for you so far when you've participated in QIBs, or you haven't come across that?
I don't, multiples doesn't participate in QIPs, so I'm not affected by it.
That's really not
so that's not an issue for you.
In fact, if you ask me to say, you had to dream out of the box beyond getting this Moksha fund and SEBI regulations, I would basically say, it's high time, as talent is growing in this country. The only thing we have going for us is talent, in one way of speaking about this country. You should be encouraging AIFs in 5 years' time to be investing abroad in emerging markets, because all the capability is there. They know how to invest. They know how to find solutions, to use Renuka's language. So we actually have to start thinking about not only just removing friction, but also acceleration beyond that. I think in 10 years' time, like IT services, AIFs from India will be investing across the world.
Maybe you can also say the positive thing in this budget, which is that now, as far as AIFs are concerned, it's not considered business income, but capital gains tax. So we've been put on the same level playing field as the foreigners. So that should be good, right?
That's absolutely great news.
That takes away a lot of litigation.
And it also takes away a lot of tension in the profit that AIFs make and how they are shared with the GPs.
Correct. So,
But we have to see when it gets implemented, what shape it takes.
so I think that, we could go on and on this topic. I think that one topic is, of course, Press Note 3. And earlier, AIFs were not subject to Press Note 3. But today, life has changed since the October 2024 circular. Now, Press Note 3 is one of my peeve points because I've been shouting about it since 2020. And AIFs were, by and large, not really scrutinized. But now from the circular, I think what it says is that if 50% in your AIF are from land bordering countries and you make more than a 10% investment in a target, then there's reams and reams of SEBI reporting and information gathering. And I think IVCA has put out an excellent advocacy paper to the government, and we're hoping that it has some traction. I think it should. I think the first suggestion is that really when you look at Press Note 3, you look at the GP, not the LP, because it's the GP that's controlling the decisions. I, for the life of me, don't see how these unintended effects have come to pass. Because Press Note 3, its stated object was to prevent takeovers by Chinese companies at depressed prices. What has that got to do with either our domestic GPs or the foreign GPs? They are certainly not controlled by Chinese unless they are, which will be few and far between. But I think the test should go to the GP element as opposed to the LPs, because the world is taking money from land bordering countries, and then to go up this SBO test and the ultimate beneficiary ownership test is impossible. If you have a listed GP, how do you know who's investing in it every day? If you have a listed LP, how do you know who's investing in it every day? It's so fluid, it's so static, and what sort of declaration are you forced to give, which may be inherently not true the next day. So I think there has to be a sensible outcome on the Press Note 3 debate. And then if you do have to go to the government, it's inordinate delay. There should be something, as IVC has said, that, either there's a green channel where you get tested once and for all, and then whatever you do as that fund or GP is allowed because you've passed the test, so to speak, unless they're sensitive sectors. If they're minority deals, is it really a problem? And what is the threat of the land neighboring country that you are perceiving? Before Press Note 3, I understand, Renu and Gopal would know better, China was the largest investor in Indian startups, the largest. And that all has gone, and that, of course, has affected the economy to some extent. I think that if we take the position that the LPs are really passive investors and the control-making decision maker is the GP, then we should shift our focus about Press Note 3 to the GP rather than the LP. I think this also, Renu was saying, affects the fundraising capability of domestic funds. And maybe, Renu, you can amplify a bit on that. How you've stayed away if you think you'll have a Press Note 3 problem from your LPs. How you would stay away from those investments if you think it would constitute a Press Note 3 problem when you take those $100 million.
No, Press Note 3 actually, even in the value chain of a potential investor, if there is a vehicle, correct, in those jurisdictions, you're not able to take money. So at multiples, actually, we had to leave hundreds of $1 million away, because of Press Note 3, stipulations. So I think, Zia, the point that you made is the most relevant one. Finally, if the manager is domiciled in India, and manager has all the control on the underlying assets, why should the source of funds, as long as it meets the KYC norms, which are very, very stringent, be a problem is a big question. But the biggest complaint I have is a complete apathy by publicly owned domestic institutions to understand this product. You know, if India is getting $50 billion, anywhere between $30 to $50 billion every year from abroad, all of them are hungry for returns. They are not coming for the love of the nation to create jobs here. They are coming for the returns. How is it that domestic institutions have completely drawn a curtain and chosen to remain on the other side? You know, the learning, the understanding, the desire to engage with this product and generate that incremental alpha, which is flying out, has not touched any publicly owned institution. That is a matter of great concern for domestic managers like us. We can keep screaming that we need to raise more domestic capital, but the HNI flow is very, very limited. Whereas, as Gopal said, the domestic pension funds, endowments, and even publicly owned insurance companies have humongous capital and complete apathy to this product. So if IVCA can do something with the help of MOF to kind of make their understanding better, discomfort lesser, engage more with the industry, choose proven managers, and then, you know, take more riskier bets, that's what will make the domestic industry thrive.
Okay, I think we've run out of time. We have time for maybe 1 or 2 questions to Gopal and Renu. Yes. You can introduce yourself and they get a mic.
Hi, I'm Karthik. I'm from Sundaram Alternates. I have a question to both of you, actually to you as well, Zia. I know you talked about a lot of divergence in regulations and so on. Now, what do you think about the new SEBI regulation that allows mutual funds to set up special investment funds that can pretty much do stuff similar to what AIF does, both on the equities as well as the credit side? Do you think that's a cannibalization of the AIF industry? I'd be curious.
Gopal?
I actually think it's a good idea because fundamentally, as the market is growing, you also need equity, public equity managers to start taking some differential level of risks to manage the market standard deviation in a better way. So fundamentally, you don't have active hedge funds or quant traders, the scale that you have. I'm assuming these are going to be only for listed equities, is how I understand the law as what I saw from IVCA. So having a special new asset class, you're talking about NAC, right? So new asset class will be good. It should basically manage the standard deviation and volatility in a tighter way is how SEBI looks at it, and I don't see any issue. I think we should not worry about these words like cannibalization. In my mind, that's an old era license Raj model. If you increase your capacity, you will create unnecessary economic activity without result. That I think we should leave it to market. Market and competition are two realities that we should embrace at all times.
Last question. No one? Okay, so thank you IVCA for having us on this panel. It's been a pleasure to moderate Renu and Gopal. I hope there are some learnings. Thank you very much.
Yeah, thank you very much. And also what we'll do is we'll take 5-6 muddas from this conversation and send it to IVCA as a
I think
suggestion.
so.
Thanks.
You've just given them work to do.